Mohamed El-Erian is with me. He's the advisor at Allianz and the president of Queen's College, Cambridge. He's in New York. It's good to see you, sir. It's bizarre. I mean, this zero COVID policy that China is implementing, we can discuss whether it, the political, if you like, but the economic effect, as long as this productive engine is either stalled or in reverse, what's the effect for the rest of us?
So it has two effects, a demand effect and a supply effect. The demand effect means that the Chinese are buying less, and as a driver of global demand, it is a much weaker engine. Then there's a supply side that's probably more problematic, which is it is disrupting supply chains. So for the rest of the world, it results in that awful phenomenon of stagflation, lower growth and higher inflation.
If this is the case, do you believe that the US will skirt a recession? And I guess, the two negative quarters or whatever, do you think they'll manage to do the soft landing at the Fed?
So two different questions. Do I think we can skirt a recession? I think we can because the labor market is so strong. Do I think the Fed can soft land the economy, meaning it can bring down inflation in a very orderly way? No, I don't. I think that the Fed is going to struggle. Where we get into a recession is in one of two situations. If the Fed not just struggles, but ends up making a major policy mistake, and already has made a few of them, or alternatively, if we get a massive market accident. So keep your eye on both these things, but in general, the recession is a risk scenario, not the baseline.
Right, but when you talk about a market accident, with so many investors having ploughed their 401ks, their pension funds, all around the world into growth stocks, now seeing sharp volatility and losses, that in itself has its effects. So I wonder, what does one do? What does the investor do at the moment?
So it's very tricky for the investor because we are coming from a situation where markets are incredibly distorted. When the Fed balloons its balance sheet to 9 trillion, in the process of doing so, it distorts markets. Now, in the good old days, both the bond prices and stock prices were going up at the same time, so no one really cared. But now that they both go down at the same time as the Fed withdraws liquidity, you cannot hide. And the most unsettling element of today's market is that there is nowhere to hide. And that is making people really nervous.
Because, not unreasonably, those people who are told, look, invest in bonds as you get older, because, that's for your safety and security. The 45, 65, becoming 50, 50, reversing in the ratios. Doesn't make any difference.
It doesn't. I mean, remember, government bonds are known to be risk-free.
Right.
They are supposed to do well when the stock market does badly. But when you start from a situation where the Fed has bought so many bonds that it artificially pushed the price so high up, there's only one way to go, down. And that's what investors have experienced. And it's a pretty horrible feeling because there's no safe havens.
So if we look at the interest rates, now neutrality, 2.5, 2.75, 3%, do you think that the Fed is going to have to go beyond neutrality? And if that's the case, then we are talking about interest rate rises, until well into next year and beyond.
So let me distinguish between what they should do and what they're likely to do.
Good idea.
What they should do is, yes, they should go beyond neutral, and they should make sure that this inflation problem doesn't become embedded in the economy and last well into 2023 and undermine growth and undermine and worsen inequality. That's what they should do. But I suspect what the Fed will do is a stop-go. It will hit the brakes, and then it will get nervous. It will ease off the brakes too early. And I suspect that what we're going to get is not getting beyond neutral and ending up with an inflation problem that persists next year. That's my big worry right now, Richard.
When we talked right at the beginning of this, early last year, you said that the inflation wasn't transitory. You're one of the first people who came out and said that. If you could see that, why couldn't the Fed?
Simple reason, the Fed wasn't looking in the right place. If you listen to companies' earnings call, one after the other, starting in May, we're saying, we don't think this is transitory. We don't think our supply chains get fixed that quickly. We don't think transportation gets fixed. We don't think the labor market, we're having difficulty. If you had just listened to what company after company was saying, they were basically telling us, don't get stuck on this transitory inflation narrative because it may not be the case.
You said I can learn a lot about Jenga and about strategy and about the way investors think about things. What can I learn?
So there are two types of players. There is the one who just wants to make it through their round, so they do the safe thing. And there's the one who looks forward to 2 or 3 rounds and tries to undermine the other player and takes a lot more risk. I think right now, if you're an investor, do the first one. Just get through these markets because they're still tricky. Don't try to take too much risk, not yet.